And the question is, so what happens when the other shoe drop and they announce additional tariffs? Let's take a look at the S&P futures right now, and you can see what happened. Just prior to the open, it was good for about 16 points to the downside. That happened a little after 8 o'clock Eastern time. There you see, let's take a look at that. And there you can see right here, we moved to the downside here. There we go, thank you. 16 points on the downside. So that's what it's worth when we have China deals announced. If you look at the usual tariff names, they're coming in as well, and that's very important. The typical names, your Rockwells, your Deeres, they're down about 2 or 3% overall. Apple's down about 11% since, what, 2 weeks ago? So it's down again today. You see that? Move to the downside there. So we're 11% off the high. We were, what, 212 just a short while ago, less than 2 weeks ago. But even the normal consumer stocks are down. Companies that don't have a lot to do with China are down. Molson's down, Conagra's down, Kraft Heinz is down, if you take a look at that overall. And these companies don't have a lot to do with China, but it's not about China. It's about lower global growth expectations. It's about lower global earnings. That's what the trade war is. If we get a lower trade war, everything comes down, not just stuff that has to do with China. People need to understand that. So when we look at the tariffs in the market today and what's going on, we get China tariffs coming in, target agricultural products, but we have more. We have discussions over there. They may reduce Boeing orders and maybe other things. They may not participate in treasuries. There's a lot of other knock-on effects we still haven't priced in. UBS just talked about what we already priced in. A 0.25% decline in GDP just for the Friday numbers, and we don't know about additional tariffs from the Trump administration coming as well. The point here is lower global growth reduces global earnings expectations and the market multiple overall. So look, we talked about how expensive the market was. Last week we did this. 17 times forward earnings is what the expectation was last week. Today it's more reasonable. It's cheaper. It's down to 16.5. The historic average, though, is still much, much lower, 15 to 16. Let's say we put a normal multiple on the market right now. Let's put 15.5. We'll just take it right in the middle. This is how you get to 2,600 very quickly. You take the numbers, the forward earnings expectations for the market, put up the next full screen. Well, on the upside, if you get a trade agreement, maybe you'll get to 3,000. But if you don't, put a 15.5 multiple on the market right now, you get to about 2,650, and that's without reducing earnings expectations. That's just lowering the overall multiple. The important thing here is we still could have a long ways to go. Big sector leaders in 2019, they're all cyclical stocks. They're all up really big. So technology and all of the overall numbers are up really, really big right now. Here's the remarkable thing, folks. We're only 4% off of the old historic highs for the S&P 500. And if you look at the Shanghai, it's true. The naysayers are right. Shanghai has suffered a lot more. Shanghai's about 11% off its recent highs that we hit right there. One last thing, you want to look for a good stock this week? Alibaba's reporting on Wednesday. There's the stock you want to see. There's 100% exposure to China. And if China's really suffering a lot, you're definitely going to hear a little bit more from Alibaba.